Hey everyone, there's a reason the greatest investors in the world always study the past. Because history may not repeat itself exactly, but it often rhymes. Whether it was 1992, 2008 or 2020, every bull market brings new heroes. And every crash exposes who was swimming naked. As retail investor, we often get caught in the same traps. Hype, herd mentality and blind faiths in the narratives. However, if you study the history, you will identify some common pattern among companies that destroy investors' wealth. I strongly believe that such companies immensely help in avoiding the same mistake in this current market. So in this video, we'll look at 5 stocks that were once investors' favorite, full of promise, momentum, media praise, and many analyst firms rated them a buy, but they ended up destroying serious wealth. More importantly, we'll break down the real reason behind their downfall and try to identify the common pattern. So you can spot the red flags early and avoid repeating these mistakes in your own portfolio. Alright, let's get started. So the first biggest wealth destroyer is Reliance Communication. Back in the mid-2000s, Reliance Communication or RCom was riding high on telecom revolution. The company had over 100 million subscribers, was expanding aggressively and was backed by the powerful Reliance brand, this time under Anil Ambani's leadership. Between 2005 and 2008, the stock went from around 100 rupee to nearly 850, an 8 times rally. Retail investors, funds, even global players were bullish on India's telecom boom and RCom looked perfectly positioned to ride the wave. At its peak in early 2008, Reliance Communication had a market cap of around 1.6 lakh crore rupees, making it one of the top 10 most valuable companies in India at that time. But here is what happened behind the scene. To fund its expansion, RCom took a massive debt, betting heavily on capital-intensive projects like undersea cable networks and spectrum auctions. The company ventured into too many areas without a strong core cash-generating business. And then came the Jio moment. With free data and zero tariff, it disrupted the entire industry. The players like RCom, who were already struggling with high debt and outdated infra, simply could not survive. By 2017-18, RCom defaulted on its loan. Its operation collapsed and stock that was once traded at 850 crashed to under 1 rupee. Today its market cap is negligible under 500 crore, which means the wealth destruction is over 99% from peak level. And here's the painful part. Many investors held on purely because they trusted the Reliance brand name. What is the learning? Well, never invest based on legacy or big names alone. Always track the financial health of a business, especially track the debt levels in capital heavy sectors like telecom. A good brand cannot save a bad balance sheet. As a rule, I always try to avoid companies where debt to equity is more than 1, with some exceptions like L&T. Then second big wealth destroyer is Yes Bank. If there is one stock that epitomizes how quickly fortunes can turn in Indian stock market, it's Yes Bank. In the early 2010s, Yes Bank was the darling of Dalal Street. Back-to-back profit growth, clean loan book, aggressive expansion, it had everything investors love. By 2018, its market cap touched a staggering 1.2 lakh crore rupees and the stock was trading at above 400 levels. Many believe this was the next HDFC Bank in making. Mutual funds, FIs, even retail investors loaded up on it. But what followed was a classic case of how growth at any cost can backfire. The first crack appeared when Rana Kapoor, the flamboyant founder, was denied a term extension by RBI in 2018. That was the first red flag. And history teaches us when regulators intervene, don't ignore the signal. Then came the evergreening loan, mounting NPAs, and the shocking revelation of toxic asset on the book. By 2020, bank was on the brink of collapse. Depositors were panicking, RBI had to step in, and a rescue deal was stitched together with SBI and other banks taking over. From a high of over 400, the stock fell down to less than 10 rupee, wiping out over 1.1 lakh crore rupees of investor wealth. What is the key learning? Well, don't get carried away by high growth without checking quality. Always track management credibility and regulatory red flags. And in bull market, banking and financial sector stocks can expand aggressively with massive profit. But that growth might come at a cost of poor lending practice. So always keep an eye on asset quality. Avoid banking and financial sector stocks that have high NPAs. Then third wealth destroyer is Vodafone Idea. There was a time when Idea Cellular was a rising star in India's telecom industry. Backed by the Aditya Birla Group, it was expanding fast, especially in rural area, and had built a solid subscriber base. Then came the merger with Vodafone Idea in 2018, a move that was supposed to create India's largest telecom operator with over 400 million subscribers. Investors were thrilled. The merged entity, Vodafone Idea, had scale, spectrum and brand visibility. At its peak, company's market cap crossed 90,000 crore. But beneath the surface, trouble was brewing. Just a year before the merger, Reliance Jio had entered the market with free data, free calls and deep pockets. The telecom industry was disrupted overnight. And Vodafone Idea, it was caught in the worst possible situation. First, high debt from the merger. Second, declining revenue due to brutal price war. Third, AGR dues slapped by Supreme Court with over 58,000 crore in liability and weak promoter commitment. So Vodafone PLC made it clear that it won't infuse fresh capital. By 2023, the stock had fallen from above 120 level to under 10 rupee, wiping out more than 80,000 crore in investors' wealth. What is the key learning? Well, mergers don't always lead to synergies, especially in disruptive market. Second, avoid companies stuck in price war with deep-pocketed competitors. Third, if a company has high debt plus regulatory uncertainty, avoid it. It's a dangerous combo. Although Vodafone's story is not yet over, Indian government has now become the largest shareholder in the company with 49% stake. Some people jokingly say that if government add 2% more stake, Vodafone will become a PSU company. To many retail investors, this looked like a green signal. If government owns 49%, how can the company fail? But here is the reality check. This is not a strategic investment. It's a debt recovery move. The government has no intention to run the company and it won't fund its expansion. Vodafone still needs to raise over 45,000 crore to survive and roll out 5G. Meanwhile, it keeps losing subscriber, its ARPU is the lowest in the industry and competition is running ahead at full speed. And yet, despite all this, millions of retail investors still buy into the story because the narrative sounds hopeful. Then fourth wealth destroyer is DHFL, that is Diwan Housing Finance Limited. In September 2018, IL and FS defaulted, triggering panic across the NBFC sector. Suddenly, market began questioning how NBFCs like DHFL were funding their rapid growth. It turned out DHFL had raised money through short-term instruments with repayment of 6 to 12 months. But it used that money to give out long-term loans for 10-20 years, a classic mismatch. As liquidity dried up, cracks began to show and the stock crashed 60% in just a few months. But investors still believed it would recover. They did not know the real storm was just beginning. In January 2019, Cobra Post released a sting operation alleging that the Vodafone promoters had siphoned off 31,000 crore via shell companies. By 2020, DHFL defaulted on multiple payments. Eventually, it went into bankruptcy proceeding under IBC, and in 2021, CBI and ED confirmed massive financial fraud and Vodafone brothers were arrested. The stock, once at 650 rupee, went to 15 and eventually got delisted. Now, what is the learning here? Well, high growth in lending is not always good, especially when it is built on shaky funding. And don't ignore the sign, like sudden rating downgrade, promoter pledging or whistleblower complaints. Then another key learning is corporate governance matter more than the stock price. Most importantly, never trust anyone blindly in bull market. Then fifth wealth destroyer is Suzlon Energy. There was a time when Suzlon was the pride of India's clean energy ambitions, a company that promised to put India on the global wind energy map. Suzlon started as a small textile business that pivoted into wind power, and it worked beautifully. By 2007, Suzlon was not just a success story, it was a phenomenon. Its stock was flying, its market cap crossed 60,000 crore. Investors believed this was just the beginning. Suzlon had global ambition. By 2007, it acquired a German company, RE Power, for over $1.6 billion. The idea was to become a truly global renewable energy powerhouse. But in chasing that dream, it made one fatal mistake: debt. Tons of it. By 2008-9, the cracks started showing. Some of Suzlon's turbine blade had structural issue leading to legal trouble and cancelled orders. Then global financial crisis hit and wind energy demand slowed. RE power turned into liability and Suzlon, which had borrowed heavily to fund its growth, began to feel the heat. It defaulted on its foreign currency convertible bonds, operational losses mounted, promoters' stake kept getting diluted, interest costs ballooned, and the market punished it mercilessly. The company that once symbolized India's clean tech future was now seen as a debt-laden failure. For the next decade, Suzlon kept trying to survive. Assets were sold, business was restructured, and while India's renewable sector kept growing, Suzlon could not participate meaningfully. In recent years, Suzlon has made effort to turn things around. Debt has come down, operations are stabilizing, and the stock has shown some signs of life. But let's not forget, for most long-term investors who entered during the hype years, the wealth is gone and the wounds run deep. There's a reason why stories like Suzlon matter, because investors, especially retail ones, keep making the same mistake. We fall for narratives. We trust big promises without looking at the number. Suzlon teaches us never invest blindly in hype. Global expansion means nothing if it is built on fragile foundations. And most importantly, debt is a silent killer. Even a futuristic business like wind energy could not save a company that expanded without discipline. Now let's look at some common patterns in these companies and learning for retail investors. So first pattern is excessive debt. Debt to equity ratio of more than 2 to 3. Second pattern is corporate governance issue. Promoter pledging, sudden resignation, auditor exits. Third pattern, aggressive accounting or too good to be true numbers. Fourth, unsustainable business model, especially in boom cycle. And fifth, promoter obsession and personality cult, including your examples of Yes Bank and DHFL. You know what is the funny part? All these stocks are favorite of retail investors. Reliance Communication still has over 15 lakh shareholders, mostly retail. Yes Bank has around 63 lakh shareholders. Vodafone Idea has around 60 lakh shareholders. Suzlon has more than 56 lakh shareholders. Do you know why retail investors love these stocks? Well, first reason is because they are cheap. 5 rupee, 10 rupee, 20 rupee, it feels like there is limited downside. But that's an illusion. A 400 rupee stock falling to 5 rupee has already destroyed 99% wealth. Second reason is there is hope. We tell ourselves, what if it turns around? We hold on not wanting to book a loss, chasing the mirage of recovery. Third reason, the narrative is addictive. Media, influencers, forum, all spin stories to comebacks. And human love stories, especially the rags to riches kind. And fourth, we confuse price with value. Just because something is cheap does not mean it's valuable. A broken business does not become a bargain, it becomes a trap. So what is the learning for retail investors? First, never blindly trust star rating or media hype. Second, always check free cash flow, not just profit. Then third, look for companies with low to moderate debt, transparent promoter behavior with no pledging, no frequent restructuring, then consistent return ratio with ROE and ROC more than 15% over multiple years. With simple, understandable model, and there's a bonus tip. Track resignation of auditors or independent director as warning signs. There was a recent example of Gensol Engineering that I have discussed in detail. Again, a classic mistake that could have been avoided if you have learned from the history. Okay, let me not stress this video. At the end, I would say that you may never be able to avoid every single well-destroyer stock or market accident. But if you learn from history, the past mistake and warning sign, you can avoid majority of these costly errors. And that makes all the difference between losing money and building lasting wealth. So keep learning, stay disciplined, and always question the narratives. If you find this video helpful, don't forget to share it within your family and friends. I'll see you next video. Till then, take care.